Hello. So this session we're going to look in detail at the operation and effects of an emissions tax. The outline, we're going to start with a simple model of the global economy with all businesses and households and governments polluting. And then we'll look at the effect of a pollution or emissions tax on individual products. So the tax initially falls on a small number of polluters, such as the electricity generators, but then the higher costs cascade through the economy to other businesses as they use energy inputs and to households as we purchase electricity and other products. So let's think of our simple model. We've got on our horizontal axis again the amount of pollution. And at the moment, pollution's a free good. So we can pollute for zero. So we're operating here at quantity business as usual. So this is our starting point. And what we want to do is reduce the amount of pollution. And remember that that's done along the marginal abatement cost curve. That has the lists of activities that we change that involve much less pollution. And as we reduce pollution more and more, it's more and more costly things we have to change. So what if we put on a carbon tax? So we're going to put on a carbon tax here of T. So in a country like Australia, that's $23 per tonne of CO2. And so then all businesses that pollute and are subject to this tax have to make a decision. They're essentially facing this charge of T. So if we think of a line along here, those who've got low cost types of pollution down here have decided, well, rather than pay the tax, the T up here on the red line, I'm going to change my decisions. I'm going to find a less polluting way to make electricity. I'm going to purchase products that are less polluting. So we're going to give up this amount of polluting activities. So long as the tax is greater than the cost of giving it up, then I'll give it up. But what about these people up here, the very expensive polluters? It's very hard for them to reduce pollution. They say, well, if I give up the polluting activity, I have to give up this amount of cost. But if I pay the tax, I only have to pay this much, I'll win. So they'll keep polluting. So they'll stay in business. And so we end up at this story Q dash, and what we've done is reduced our amount of pollution. That's the desired effect. So let's think about who wins and who loses. First, think about the government. The government is charging a tax of this OT, and people are polluting at this amount. So this is the pollution. So they're picking up a nice little piece of tax revenue, which we call the rectangle A. So this is a great money spinner for government. But of course it's not all quite that good. What's happened to households and businesses? Well, they have to pay that tax. So that's really a transfer. But they've also now had to choose more expensive ways of producing their energy, but less polluting ways. They've had to do a little bit more walking rather than driving to work and recreation. Less polluting, but a little bit more expensive. So they also incur those amount of costs. So the buyers and the producers of polluting products lose the rectangle A plus that triangle B. So this looks all bad news, doesn't it? But remember, we have reduced pollution from Q business as usual to Q star. That has reduced the amount of build-up of carbon dioxide and other greenhouse gases. reduce the amount of climate change, and so we've saved ourselves this big amount, area B plus C, of less costs of climate change down the track. And it's that area C, if we net all this out, this area C is the net gain. That's why we want to do it. But what we're seeing is there are some winners and some losers. And what this slide does is summarise that story for you. Pollution falls, and it's going to fall more the flatter that marginal abatement cost curve, that is, the easier it is to change from more polluting to less polluting ways, and the larger the tax. And that curve will be more responsive the larger the tax base. If we have every type of pollution in it, then it's going to be easier to respond. It's going to find the least cost ways of reducing pollution. Remember that the low-hanging fruit decided, I will change my ways and avoid the tax. The more expensive items said, no, I will pay the tax and keep polluting. Government gains tax revenue, producers and consumers lose. Part of that loss is just a transfer to the government, but there's a little bit more. There's a reduction of costs of climate change down the track, so that's the benefits. And there's a net society gain of area C. And so that diagram on the previous slide is sort of documenting the story that develops this. So let's now move from looking at pollution as a sort of an aggregate bad product to all the different products that we buy and sell. And as we remember, activities are going on in the pollution production stage, but households buy the electricity and transport, and businesses use energy as some of their inputs, which they then send onto households. So we want to look at some of these individual decisions. So if we again go to our simple story of supply and demand for a desired product like electricity, movies, driving on holidays and so on this horizontal axis, we've got the quantity of these desired products. The vertical axis, we've got the price. The demand curve tells us that as the price falls, we're willing to buy more and more of these desired products. The supply curve, which is upward sloping, tells us that if we pay a higher price, then more producers will come into the market and we'll get more product. Now the important thing is, before we have any tax on greenhouse gases, this supply curve just depends on MPC, marginal private costs, for labour, capital and so on. We don't worry about any pollution costs. That's a free good. And so then we will find the market, how much will we produce and consume, will be where these two curves intercept. This is our equilibrium. So this will be the production and consumption of electricity, transport and so on. This will be the market price. So what we want to do now is say, what if I put a tax on the pollution? And I'm going to call this tax, this term, APC. The P really is the tax per unit of pollution. The alpha tells you how much pollution is directly produced by the product or indirectly on inputs. So if we have a product that's very pollution intensive, we're going to get a big shift upwards in the pollution tax that's in part of the product. If, on the other hand, we product that had very little or no pollution, the cost increase would be just a very little bit. So what happens then if, say, we have a tax on burning of coal to make electricity, and this is a washing machine, it's one of our desired products, that uses lots of electricity. It's now more expensive to operate. Rather than being at this initial nasty equilibrium, we're now going to move to the green equilibrium at this point. So what the tax has done is induced us to buy and produce less of that pollution-intensive product. And so yes, we have less of these nasty washing machines, we have less driving of our cars, and it's rationed to us by a slight increase in the price, and we've also got less pollution. So some observations. The more greenhouse gas intensive pollution the product, the greater that cost increase. So the bigger the shift upward of the supply curve, the more we change the decisions on that pollution intensive product. And products with virtually no pollution, our decision would not change very much. What we also realise is that most of that tax is passed on. So here we have the interesting story that if we put a tax on the burning of fossil fuels by electricity generators, they write the tax to the government. But in fact, they then put up their prices. And so when you and I buy electricity, we're paying more for the electricity. Indirectly, we are paying for the pollution. And so this is a very important point in the economics of this debate. Business will grizzle and complain that they're paying the tax. Yes, they're writing the cheque, but the way markets operate, they're able to pass most of those costs forward to you and I, and we're the ones who pay for it. But that's fine, because we want to change decisions. So what is the effects of a tax on greenhouse gas emissions on employment? That's what economists call a story of creative destruction. If we think back there a little bit more, production processes and products that have a lot of pollution directly or indirectly, their prices are going to rise quite a lot. There are other products that involve very little pollution directly or indirectly, their price is not going to go up very much, if at all. So in terms of those polluting products, less production means less jobs. So that's what we call job destruction. We lose jobs in the polluting activities. But those products that are not very polluting have become relatively cheaper. So we move to more employment in these less polluting production processes, less polluting products, and lo and behold, that creates jobs, job creation. We're also spending money on R&D to find these new technologies to reduce our amount of pollution. Again, that's job creation in an exciting, interesting job. And so in net, the aggregate employment effect is close to zero. The reality is in politics is we're going to hear all the grizzling from those who lose jobs, and we're not going to hear very much from those who find new jobs created. The strength of the economic argument is to say those two will roughly balance each other.